Welcome to the third session of our weekly webinar series, DVBIA Members Helping Members. We're so glad that you can join us online today. If you've been on a DVBIA webinar before, you'll know some of the technical aspects of how we operate. But before we jump into the content, I'll quickly walk through the process for those of you who are joining us for the first time today. You'll notice that all the participants currently have their microphones on mute. We ask that you submit your questions in writing today via the Q&A feature, and that's located at either the bottom of your screen if you're on full screen mode, or you can hover your cursor over the main screen and it should show up. Our presenters will be addressing your submitted questions after their presentation, but please feel free to submit your questions at any point. So let's get into today's programming. Today's topic is presented in partnership with Deloitte, and it's called Navigating COVID-19 Government Relief Measures. Leading our programming and answering your most pressing questions will be Deloitte's David Mueller and Cam Nat. David Mueller is the BC Tax Regional Market Leader and a tax partner in Deloitte Private. He has 20 years of experience providing tax consulting strategies to both privately held and publicly owned organizations. He specializes in tax planning in the areas of corporate reorganizations, estates and trust, intergenerational transfers, and partnerships. David's taxation experience includes clients in a wide variety of industries, with a particular emphasis on real estate, including public-private partnerships. Cam Nat is also a tax partner in Deloitte Private and has over 14 years of public practice experience. He advises clients on corporate reorganizations, intergenerational transfers, estates, trust, and mergers, and acquisitions across a wide variety of industries, including real estate and construction, technology, and manufacturing. Cam is also a member of the Society of Trust and Estate Practitioners of Canada and Canadian Council for Public-Private Partnerships. And now, without further delay, I'll hand it over to David, and they'll take us through their presentation.
Thank you, Charles, and thanks to the Downtown Vancouver Business Improvement Association. I always want to say DVBIA, but it's a lot to say when I'm not used to it. But thank you for letting us present on COVID-19 tax-related issues and opportunities that we're seeing with our clients. I think you had a good introduction of Cam and I. We together probably have 30 plus years of experience with income tax and about 7 weeks of COVID-19 tax planning. So as we come live from our condos in Vancouver, I'm sitting in the corner of my bedroom, and Cam, I think, is out in his family room. And I have a nice Vancouver artist behind me there with Georgia Viaducts. You can sort of just see it in there. So I thought I'd give everyone a bit of a view. Cam and I, and really Cam's going to lead the presentation, and I'm going to try to add comments applicable to the members of the Business Improvement Association over the next sort of 15 to 20 minutes. I think there's 3 slides, and we're going to have a question and answer period after. So our main topics are going to be the Canada Employment Wage Subsidy, which is taking up a lot of our time. So I'll refer to it as CEWS, and I think Cam calls it Qs, but that's what we're talking about, the wage subsidy. It's actually an unbelievable tool, in my opinion. Capitalism was never meant to stop, and COVID-19 effectively stopped it. So by having an injection of capital into the individual bank accounts, the employees' bank accounts to put food on the table, pay rent, so on and so forth, I think is unbelievable. It's an excellent program. And we have unbelievable amounts of clients asking us questions, applying this week. Some it's straightforward and they can apply, and for many others it is far from simple to apply and to try to qualify. And we'll get into some of that later. And then we're going to go into what we call the golden 5+1 of tax planning. And what that is opportunities to take advantage in these, call it bad times, recessionary times, but to some business owners, it's an opportunity that you don't want to waste. So there's some tips and that we can pass along. And finally, before Cam starts, what's a tax presentation without a disclaimer? You know, our comments are effectively not advice. Please seek your professional advice from your tax providers really before acting on anything you're not 100% certain of. So with that said, Cam, please take it away. Oh,
Thanks, Dave. Thanks, Charles. Nicola, you can move to the next slide. Welcome, everybody. On March 27th, the Prime Minister announced the new Canada Emergency Wage Subsidy, and it was meant to encourage employers which have faced a significant decline in their business to rehire workers that have been previously laid off due to COVID-19. As well, it was to put them in a better position when they emerge out of the crisis. So with respect to the 75% subsidy, eligible employers, they include taxable corporations, whether they're big or small, NPOs, registered charities, certain partnerships, and the amount of the subsidy per employee is about $850 per week. There is no overall employer limit to the subsidy. And the time period lasts about 3 months. So the total benefit is about $10,000 per employee. If an employer has about 100 employees, they're looking at a maximum subsidy of approximately $1 million. Now, the legislation also allows employers to apply for 100% refund of certain CPP and EI premiums paid with respect to certain employees that are off on leave that are also receiving the CEWS. Now, if you've been following along with the legislation, you will note that it is lengthy and very technical. I like to break it down into two different components. The first one being, do I qualify? Do I meet that decline in revenue test? And the second one being, well, how much of the subsidy do I receive? And that really involves, looking at your gross payroll and then considering, have I made CPP and EI contributions to qualifying employees? So in order to qualify, the company has to have encountered a decline in revenues of at least 15% for the month of March and 30% for following periods. So, and then if an employer has been found to be eligible for one period, they automatically qualify for the next. And the purpose of that is to really provide employers with a certain amount of certainty that the relief will continue to come in. When you apply this decline in revenue test, employers have a number of different options. The first one being, I can compare my revenues year over year. So I could compare my March 2020 revenues to March 2019, or I can use the average of January and February revenues as my comparative period. Employers can also decide to compute revenues on a consolidated basis or an entity by entity basis. They can choose to use the accrual method of recognizing revenue or the cash method. One important item to note is that if you do decide to use, let's say, the average of January and February as your comparative, or you decide to use the cash method for recognizing revenues, you are going to be locked into that choice for the entire claim period.
And I think if I can add, if you want to look at the revenue test, it's quite different depending on what type of business you have. If you're a landlord and you have you have leases on your properties, your revenue for what they will call normal accounting practices in the legislation has not arguably declined. You might not be getting paid, but your revenue is still strong. So as Cam mentioned, there's an option to switch to a cash method. And that cash method would basically ignore accrual accounting and just go to, effectively cash received. So go to your bank statement. So as a landlord, you might want to think differently on how you apply and what method, because when there's an attestation form, 2 parts, I think it's like 3 parts, but 2 parts, there's lots of questions that you have to sign off when you apply. So very important. The same thing if you're in service revenue, you're a professional firm, you might still be having revenue build up. You have WIP build up. It's arguable if WIP is revenue, but I think it is since some changes in policy a couple of years ago. So you might want to look at cash as well. And if you're in something like retail, you're probably on accrual account, actually guarantee you're on accrual accounting, and you would arguably qualify there with just a revenue drop, a lot simpler.
Next slide, please. So there is quite a bit of ambiguity and complexity with how the legislation is designed. There are special rules for businesses that earn revenues from other members in the corporate group. There's complexity with how qualifying revenues are determined, what goes into the calculation of eligible remuneration, baseline remuneration, along with a whole host of other issues. So Deloitte's Omnia or AI team, to help our clients cut through this complexity, they have developed a technology solution which helps our clients kind of dissect all of this different data and efficiently determine if they qualify so they can maximize their subsidy. There are a number of different other functions that allows users to do. It facilitates the consolidation function. It helps you analyze the various different kind of elections and choices that you have. And then it's also scalable as well too. So it doesn't matter if you have 1 employee or 5,000 employees. So it's quite powerful. Employers, they can now apply for the subsidy. The most popular choice has been through the My Business Account portal on the CRA website. There are a couple of other options. Like Dave was mentioning, the person that is responsible for the finance function, they need to attest that the application is true and complete. So the takeaway here is that if you're applying for the subsidy, you should make sure that you qualify, because there are substantial penalties if you receive it and you weren't eligible in the first place.
Yeah, and I think a key here is you never had to have laid off any employees to qualify. It's a revenue test in this sort of the first step. If you have this 15% decline in March or 30% decline in April and May, you can qualify. So if you're still operating, you haven't laid off anyone, you have a revenue decline, you can still qualify or apply for this. So it is massive when you have, as Cam gave the numbers, but 100 employees, that's $1 million. 25 is 250. And we're saying that it's 250 in that case over a 12-week period. The legislation is worded that it's 3 periods, but it can go to and ending in June something, mid-June, I believe. But it can go to September 30th. So it's more than double that if the COVID effects are significant and the government have to continue this program. So by no means have you had to lay off people, and that's a sort of a misconception that a lot of people understand. And if you did lay off people, you do not have to hire them back. You can, or you can hire them back and keep them at home. There's a whole bunch of different options available. It's a very flexible program. So.
Next slide.
Well, and sorry, one last comment there, Cam, too, is there is a provision, and it's being worded, the name and shame, and I don't know if that's appropriate, but there's a provision in the CEWS legislation that allows the government to publish who has applied for it. In the news, you've read that, WestJet has, Air Canada has, so some of it is public, but be prepared to have your name published. I don't think that's a bad thing. It's a program that is there to help employees be employed. So if you use it for your employees, I think it's a good thing. You may want to consider, if you have upper management, for example, high income earners, not applying for them, and having that in your back pocket should you ever want to say, yeah, we applied for lower income earners, not high income earners. But something to consider is the communication of the applicants. Sorry, Cam.
Absolutely. Okay, so now on to some tax planning strategies. We call it the Golden 5+1, just because the first 5 are designed to improve cash flow immediately. And then the last one is geared towards more long-term planning. These are a few of our most popular strategies designed to specifically improve cash flow. So the first one involves revisiting your compensation model by replacing salaries with other forms of compensation. Salaries are great, especially when the company is profitable, because it provides for a deduction, and then that reduces the company's corresponding tax liability. Now, if the corporation is going to be in a loss position, that deduction is not as valuable as well. Salaries attract source deductions, so withholdings of CPP, EI, and income tax. So the point here is look towards other forms of compensation, loans, dividends, stock options. They're not going to be subject to withholdings. They're not taxed immediately. So theoretically, the employee can receive the same amount of after-tax cash in their pocket with a lower cost to the company. And on that note, it's important to highlight that the tax will ultimately have to be paid, but that's one strategy to potentially think about in order to get yourself out of an immediate cash crunch. The second strategy is basically taking a closer look at your receivables and inventory. Many companies that have December 31st, 2019 year ends, January 31st, 2020 year ends, they haven't filed their corporate tax returns. This is an opportunity to revisit initial decisions around the collectability of your receivables. Arguably, if that receivable is still outstanding today, consideration should be given if you can take an allowance against it and to receive that tax deduction. The same thing goes for inventory. If your inventory is still currently outstanding, you may be able to write that down to its fair market value. That could provide a valuable tax deduction and savings as well. The third strategy involves applying for a refund of over-remitted corporate tax installments. So many companies remit corporate tax installments based on previous year's taxable income, and that's not the only method that's out there. You can actually remit corporate tax installments on an estimate of your current year taxable income. So if you find that you're not going to be as profitable in 2020, or you're going to be running at a loss, and the company has already made corporate tax installments, it can either apply for a refund or potentially transfer those installments to another account, say your payroll account, and then apply them against future payroll liabilities. The fourth strategy involves accelerating a year end to carry back losses. So if the company is projecting a loss in 2020, there may be an opportunity to trigger a year end. There are a few different ways to do this. One could be through simplifying the corporate structure, but basically that would allow you to crystallize that loss faster, and then you can potentially carry it back to any one of the 3 previous taxation years, apply it against taxable income, and then recover taxes previously paid.
And this one's really important and can apply to a lot of entities. If you think about December year ends pre-COVID. Your tax returns were due or are due June 30th. They have not been extended, but you had taxes owing. Assuming you qualify for the deferral, taxes owing on CCPCs would, on active income, have been extended to September 1st, I guess. So let's say you have a whole bunch of losses in March, April, May, June, July, August. What you could do, and you had money, taxes owing, you had a taxable income December 31st. You could reorganize your group, as Cam said, various ways to have short taxation years, have a loss for an August year end, and carry that loss back to actually recover the taxes you haven't yet paid for December 19. And if there's more losses there, carrying back to December 18 and 17. And the key there, and the key what Cam has been talking about, is cash is king right now. We're trying to ensure everyone's liquid. And this is an easy way to, when Cam says crystallize your losses, use these losses to offset the prior 3 taxation years of income that you may have had.
So the last strategy involves utilizing losses in the corporate group. And again, there are many ways to potentially accomplish this. Some are more complex than others. All of them are dependent on the facts, but you could potentially transfer an asset which has an accrued gain to another member of the corporate group and crystallize that gain. Another thought is you can transfer a profitable company to a loss business to utilize some losses that way. You can amalgamate a profit co with a loss co. That's one loss utilization strategy. But the main takeaway here is if you have companies that in your corporate group, some that are profitable, some that are running at a loss, look for different ways to utilize those losses. That is going to reduce the overall tax burden to the corporate group. And then finally, the last strategy, it is not going to generate cash, but it helps protect your existing wealth, which is just as important. We see a number of companies that have significant retained earnings, intercompany loan balances on their balance sheet. Those retained earnings, they're exposed to the risks of the business and other creditors unless the company takes steps to protect it. And one way to do so is to simply interpose a holding company, pay a dividend from your opco to your holdco. And on that note, I want to highlight that opco doesn't necessarily need to have cash to pay that dividend. It can pay a cashless dividend, which is settled by way of a secured promissory note, which takes preference to other unsecured creditors. And so that's a similar comment if there are unsecured intercompany loans that exist. You can work with your legal counsel to securitize those loans so they take preference to other creditors.
And one note of caution there is just don't go and declare a dividend without looking at how that dividend can be taxed. We have these very ugly safe income rules that by no means we could spend a week teaching a course on. So a dividend isn't as simple as just paying it. Definitely, as with the others, get some fresh professional tax advice before you do this step 6. But the asset protection implications can be significant. So.
Absolutely. So these are just some of the tax strategies that can be employed during these times. Much of our planning, it's going to be bespoke and fact dependent. We look at how the corporate group is structured, taking a look at the tax attributes inside the corporation, understanding the nature of the activities and the business, as well as also looking at the tax attributes at the shareholder level. That's what's going to drive a holistic planning strategy, whether that's in an economic downturn or otherwise. So that's it for the formal part of our presentation. We can now open up the floor to questions.
Great. Well, thanks for this presentation. And we do have a number of questions that are lined up. And so what I'll do is I'll take them in the order that they showed up on the screen. And I have to admit there are some acronyms here that might throw me for a loop. But let's start off with the first question. Are you aware of if the CEBA is available to corporations paying their workers via dividends rather than employment income?
Sorry, which acronym was that? The CE?
BA.
Is that the C? I might be CERB.
Yeah, I'm not.
I believe it's the CERB, the Canada Emergency Response Benefit, to CERB, I believe. And so, what? Yeah, one of this. If that is, I'll answer it as if that is the question. As a business owner, some people do not take salary; they take dividends. And there's reasons for that, and it's usually investment advisors. Are they going to be able to collect CPP, old age pension? Do they want to pay CPP every year in the employer portion, which is about $5,000? So some people take a dividend strategy. There was an FAQ on the website that if you had dividends that were, I got to get this right, ineligible, so you had a small business deduction and paid dividends from your company to you, that those would make you qualify. That was early on. I haven't looked to see if they've amended that, but if you had dividends that were what we call eligible, which are can be from a public company or paid from the general corporate rate, like the 27% tax rate in BC, if that's all you receive, then you are not eligible to receive the CERB benefit. And the challenge there is it's administrative, and you have to go back to figure out what type of dividend you paid in the past. So there are quite a few people that by chance had a bit of a small business deduction, hence they fell into this administrative position of qualifying. But yeah, I think that's the question.
Okay, and if individual that posed that question wants to clarify further, I would encourage him to do that, and I'll hopefully get to that question in the queue. The next one we have is, I have a CRA business number as a self-employed sole proprietor and meet the other criteria. Do I qualify?
I would expect the answer to that, yes.
It should be yes, because you do not have to, and I say qualify for the CEWS, the Canada Emergency Wage Benefit, the CEWS. Yes, you do not have to be an incorporated business. As long as you have employees and you had your payroll number as at March 15th, and then you have to look at if it's arm's length or non-arm's length employees working for you who you're trying to qualify. Bit different tests there.
Anything to add, Cam?
No, nothing further from my end.
Okay, the next question, I do know this acronym. Any details on the Canada Emergency Commercial Rent Assistant rent subsidy other than what is reported on the news?
Cam, do you want to take a stab at that one?
So it seems like on that end, like Deloitte has been closely monitoring all announcements that have been made by the government. On that piece, it seems like we're still waiting to receive detailed notes and guidance and legislation around the commercial rent relief program. So we don't have anything really further that from what's already kind of been announced, which is just a very high level of the program to date.
The only thing I would add is that the agency that's actually going to administer the program is CHMC. What I can ask Nicola and my team to do is send the participants, the information we have as to date with the link to the website. The next question we have, this was an interesting question because it was a conversation that we were having before we started the broadcast. Given the government has injected hundreds of billions of dollars of stimulus into the economy, what are some potential tax changes, either personal and or corporate, that we could see down the road?
So that's an interesting question, and it'll be interesting to see what the government does. At simply, tax rates could go up, capital gain inclusion rate could go up. Every year since Trudeau's been in, there's always rumors, and I don't like acting on rumors and speculation, that the capital gain inclusion rate would increase. Right now it's at 50%. It's been as high as 75%. That means if you have a $100 gain, you only pay tax on $50 if it's half. So that's a possibility. At the same time, I think the government are quite aware if you increase taxes too much, above 50%, you drive an underground economy. We saw that reduce when we had the Liberal government in BC. We saw that with the Conservatives federally. There's been some good articles in the paper the last couple of weeks. Definitely the Globe and Mail has had one talking about the government debt, how they never actually have to repay any dollar of the debt they're creating this year by all the various COVID-19 response programs. And what that's trying to say, and I think the article talked about 1944-ish, the debt in Canada per GDP was 100%, 1/1. Now we're at about 20%. So we have a lot of room, especially in the G7 where we get compared to, now I'm talking economics, not tax, but to increase our debt. We just have to service that debt each year at the interest rates that it was issued at, but we do not have to repay it, is my understanding. And the goal there would be that the economy, the GDP grows to get that back down to a lower number at 20%. And I don't want to state the number, but Japan their debt is way over 100% of their GDP. So there are economies that operate under very heavy debt loads. So
that was a fulsome answer. Cam?
Yeah, no, and I'll just add to that as well too. Like there are a number of different ways and methods that the government can raise revenues. In the 1990s, there was an individual surtax that was introduced on high incomes. There was also a capital tax that applied to large corporations. As a part of the 2018 US tax reform package, the IRS introduced measures to limit the amount of interest that was deductible to corporations. So, those are all different ways that the government can potentially raise revenues and alternatives that we could see sometime in the future.
And one last thing I'd like to add is you don't hear about it anymore, but you see it somewhat in practice. The GST, the HST is quite low. It's call it 14%, maybe average in Canada, 13, 14. You go to Europe, the VAT is up in the 20s, going to be 30%. So there's theory out there, and I would challenge, and I assume the government will look at it, to actually, they could decrease the tax rates significantly and increase the GST, HST rate. And then they tax on transactions. So if you need to spend, you get taxed. If you think about the implications to BC, without running numbers, it could be significant because there's a lot of foreign wealth that has come to BC. There's reports out there that they don't pay income tax here because they don't have to. They've earned money, they pay tax elsewhere, and they've shown up here at the large capital. If you increase the tax, the GST, PST, HST, you could actually recover, in theory, as much, if not more, than you would in just pure income tax dollars. So something else they could consider. Will they be that bold? I don't know. So.
And Jay, just to add on to your comment when it comes to the capital gains inclusion rate, there's been a lot of dialogue on that over the last 2 to 3 years. And one of the reasons why the government may go ahead and increase that inclusion rate is because at 50%, right now, it allows business owners to strip cash out of their corporation at a tax rate that is significantly better compared to either paying a salary and dividend or a dividend, and the CRA is aware of that type of planning. They don't like it. And so that's one of the reasons why it could go up to 2/3 or 75%. But that planning is still around, and it still does exist, where business owners are looking to strip a significant amount of cash out of their corporation because there is that personal need.
And that's a very good point, Cam. There's court cases that support that you can take out surplus from a company as a capital gain and not a dividend. So by increasing the capital gain inclusion rate, you can equalize the tax rate between the two. And that's sort of partly what Trudeau tried to do in, was it the July 2017 tax reform. He came out right before summer. That's exactly what he was trying to hit. He came out and that was a disaster, poorly written, and subsequently they changed it and dropped some of it. So that would be.
I'd like to move on to a couple of other questions before we run out of time. I have a question here that comes from someone that's in the event industry. Do you anticipate that the government will extend the coverage for some of the relief beyond the 16 weeks, as the effects to the event industry will continue for some time to come? We are trying to find alternative revenue sources for our people for the event industry business, but we may be forced to break our commercial lease. Will there be any forgiveness measures? So I think we're talking about the 16-week period.
Yeah, I think I think I mentioned before, the 16-week period ends in June, whatever. The legislation was written that it can go to September 30th without having to recall Parliament. So if the effects continue, it would be a blanket provision right now, my understanding, to they could pass this to end of September. For the the events industry or fishing industry or something specific, they would have to go and change the legislation if they want to target it somewhere. But right now, the ability is there for all industries to continue on to end of September.
And on that note, some of the earlier kind of comments that we made when it came to the maximum amount of the subsidy that the employer can claim for an employee. I gave that example. Well, if you have 100 employees, then your maximum subsidy is $1 million. That would more than double that amount, because right now the existing period, it's about 12 weeks. It's about 3 months or so, but we can extend that potentially 4 additional periods. So there's 7 of them. So you want to make sure that if you are locking yourself into certain decisions, like whether you're going to use the cash method versus the accrual method for recognizing revenue, or you're choosing the previous year as your comparative period versus the average of January and February, that you're making an informed decision and you're using all of the data that you have potentially available to you, because those decisions can be tied in for ultimately 7 periods.
This is another great question. They're all great questions, but this one I think I haven't seen this one before. You said the CRA portal to apply for the 75% subsidy opened on Monday. Does it make sense for me to wait to understand what my revenues are for March, April, and May, or should I try to apply as fast as possible?
So you should definitely consider, as we've been saying, what method you use and what you project your revenue to be. It's a lot more complex when if you're a landlord that has, and I have clients with over 100 entities, 150, and then only certain entities have payroll in it and they allocate the cost around. Highly complex. They're in no rush to apply because they want to wait to see what's the most beneficial way to ensure they can qualify. Because, as I say, landlords, that's quite complex. If you're just retail, not say just, if you're in retail, it's probably pretty obvious what what your if you're in retail, it's cash. So I think you don't have to definitely go to cash. You just use normal accounting practices and services. You want to sort of think about it, but definitely the key there is to do a bit of pro forma work. Look at last year's comparatives if you're using year over year versus January and February of the current year method, and then just look how it's hit you in April. And the way the legislation is written, they're sort of giving you a look back. The periods are like mid March to mid April, and then by the time you want to apply for that, you already compare that on your March revenue, so you know your revenue's down. And once you apply for qualify for one period, you automatically get a +1. So now you can go that same thing end of April, see if you can apply again. So pro forma, look ahead and plan.
And make sure you submit your application by September 30th.
Okay, our next question is, we are a partnership and each partner is a CCPC. I understand the criteria to qualify for CEWS is that each CCPC should have positive business limit. What does a positive business limit mean?
I don't know that term, Cam.
I don't think that applies to the queues. So there were two different subsidies that were announced in the last 45 days. Originally, earlier in March, there was the temporary wage subsidy, or the 10% subsidy. And in order to qualify for that one, you must be considered a small business corporation, which means that your taxable capital has to be less than $15 million. And the company applying must have been allocated a portion of the small business limit. So the person who asked that question, you could be just referring to the 10% wage subsidy.
And if there's a partnership that all the partners are CCPCs, more importantly, not a non-tax exempt entity like a pension plan. If that's the case, then you look at the partnership and see for CEWS to see if it meets the revenue decline test. If it does, it should therefore apply. Look at the details, but it should qualify, and then I'm able to apply.
The next question I have is, if someone has been collecting the Canada Emergency Response Benefit, how does his or her transition, how does that occur to get the wage subsidy?
So if you, and this is my understanding, if you've been claiming the CERB, and there'll be quite a few instances because people may have been laid off in March, and they need to take care of their finances, their family, their personal circumstances, they would have applied. So now the way the legislation has come out, we're in the end of April, almost May. So they're allowing you to retroactively rehire your employees that could have been laid off. And if you have CERB, you probably were laid off or had your hours significantly reduced such that you're making less than $1,000 a month, that you can reapply. So what will happen is the employer will apply on the portal. The employee is going to be required to repay the CERB, the $1,000 that they're claiming in each month. So.
I got a comment here. It's from an economist who's, it's more of a comment than a question, but I think while we wait for some more questions, might be worth to have a discussion. It seems the way to stimulate the economy is to reduce the GST and all forms of sales tax, encourage people to spend. Thoughts?
If you have your income tax, that could make perfect sense. Look at Alberta. It's worked in the past and maybe not so much in the last decade, but I myself have an economics degree, over 20 years ago. And I was more studying the impacts of actually increasing the sales tax and decreasing income tax. But I would see the reverse benefit. I think you can go both ways. The difference, I think, if you have a good sales tax collection mechanism, you collect it right away. and you don't have as much evasion, arguably, than you could if someone in Europe. There's a lot of transient population that doesn't pay income tax. They just move around. So.
Okay, reminding everyone we have about 12 minutes left. I'm running out of questions, so if you do have a question you'd like to pose, please do so in the next little while. But I do have one in the queue here. I'll just abbreviate it because you already answered part of the question. Do you know when we can expect a federal budget?
Well, the budget was originally supposed to be slated for March 30th, and then Parliament was delayed. There haven't been any announcements or comments from the federal government as to exactly when we can expect that down the road. I would suspect that, they need to prepare some sort of budget to, support the amount that they're spending and to ensure that their books are balanced and that type of thing. So we're hoping that we could potentially see one in early fall.
And my gut feeling is any budget prepared is it'll be a challenging budget given COVID-19, the financial pressure that will be on the Canadian economy, and the fact we have a minority government. So it's going to be, Liberals are going to have to get really cozy with another party in order to get it passed, I think. So.
Okay, I have another question here. What happens if the landlord does not choose to participate in the rent relief? Do we still get rent relief and only have to pay 25%, or is the amount of relief on base rent only, or base rent plus CAM, off costs, taxes, etc.? I think we might have answered that one, that there's some of the details are not out there yet.
Some of the details, and when I looked at what you had sent around, the landlord has to qualify and accept, and in qualifying and accepting, the landlord has to reduce the rent by the 75%. So they're going to be foregoing some rent. So it'll be a commercial decision that they want. And I think on the flip side, the tenant has to have a 75% decline as well. So I suspect it'll be a negotiation between the landlord and the tenant if they qualify, if they want to go into rent reduction. If you have a long-term lease and they couldn't pay for 6 months during COVID, does it make any sense to kick them out if they leave you with a highly specialized shell of a building that can only be used for one purpose or another? So.
Cam, do you have anything to add on that?
No, nothing further from my end.
I'm going to read this one. Won't increasing the sales tax increase the cost of our product for our customer, which in turn will reduce the demand for our product? I would prefer sales tax stays flat, or is reduced to invigorate the market or influence the return of our customers, particularly for non-tangible products such as travel, where we want customers to rebook. We cannot afford our customers to incur high costs to rebook a product that has been canceled due to COVID.
I think that makes perfect sense, and it's sort of the other side of the coin on how you want to tax via income tax or sales tax. I don't think there's a right or a wrong answer. I think maybe the right answer is right now the majority of tax in North America is an income tax.
Okay, and then I have someone that's asking for a question or an answer to be repeated. I heard the question before, but I could not understand the answer. Dave's mic is a bit noisy. As a small business owner who took dividend last year and not salary, am I eligible for the CRB?
What type of, if they could send in, you'd have to look at your tax return if you had eligible or ineligible dividends. I would go to the CERB, the CERB website for the FAQ for the government, and one of the questions specifically, and it's right near the bottom, and this is a couple weeks ago, they may have added more FAQs, basically said, if you took dividends, do you qualify? Then it actually states if you had eligible or ineligible, and I think it's ineligible dividends allow you to qualify, but check the CERB website, the FAQ. And why that would make sense is that means you own a company, or you might not be the majority owner, but you own a company that claimed the small business deduction. And so you were taking the dividend out. And I think they must view the small business deduction as a proxy of taking a T4 in this instance.
We have a few minutes left, but while I wait to see if there's another question that pops up, I have a quick question, maybe to summarize a little bit. If there were 3 things you would suggest that the participants that they do right now to take advantage of any of the programs that are out there, what would those 3 tips be?
I would say 1, CEWS, the 75% subsidy is a game changer. It's income to a company, but it's also the expenses going out to the employees. So if you do the math, but if you 30% drop in revenue, you haven't laid off any employees, you still have a margin on their service, you're making profit, you suddenly can get 75% of their salary as a subsidy. So that's the number one, I think as employer, the CEWS.
And so as another item, and we find that a significant portion of our clients are maybe overlooking this, and this is something that is newer. So just in the last couple of days, I'd really suggest for them to explore whether they are eligible for the temporary wage subsidy, so the 10% subsidy. Some employers have taken the position that if I qualify for the 75% subsidy, I don't need to necessarily care about the 10% subsidy. That's not necessarily the case, because CRA has said that if you are eligible for the 10% subsidy, that will automatically grind the amount that that employer is eligible for the CEWS. So some people have overlooked that. And one of the reasons is because you need to understand, was I allocated a portion of the small business limit in the previous year? And a part of that means completing your 2019 tax filings.
And I think third, I want to do a catch-all for third. And I think what I want to say there is cash preservation. We mentioned some ideas here about moving installments around to cover payroll, because payroll's never been deferred. You could move corporate installments that you've made either beginning of this year or even last year just to your payroll. There might be interest on some of those depending on how it works, but cash preservation is key. Looking at your inventory, looking at your accounts receivable. If you have December year ends, doesn't matter what year end, but if you can take a write-off and be aggressive, and you have a bit of hindsight now that you didn't get paid a large receivable that was on your books, that you're about to file a December tax return, be a bit more aggressive than normal and take the deduction to save some cash there. Go ahead, Cam.
No, I was just going to say that it's a really good opportunity also to do some long-term planning. Asset values are currently depressed. And, like let's say in a previous year, a year ago, year and a half ago, you did a freeze, you can potentially think about doing a refreeze at a lower value. That can ultimately reduce the tax liability that an owner manager may have on their ultimate demise. So, this time is also a good opportunity to consider long-term planning as well.
And so for all my real estate clients, that's exactly what I was going to say, Cam. Especially real estate, doesn't have to be real estate. Property values are arguably down. We'll see how long the COVID goes on, but when they're not receiving, your companies aren't receiving rent, the value, the way the valuation standards work, should decrease the value. So if you're probably anywhere 60 plus on, I would strongly recommend you look at trying to refreeze to a lower value. There's a lot of flexibility that you can still take ownership back and through a trust, and it's flexible, it's discretionary, you don't have to take that value. But the decline right now, it's almost a waste not to use such a bad recession, use it to your advantage as a business owner. And if you're own any brand, your retail, your sales are down, you might want to pass it on intergenerational. Definitely look at refreezing at these lower values. The savings are significant. Savings aren't realized until your ultimate demise, or depending on how your will and trust are set up. But the fact is, it's significant.
Well, that's a great way to bring today's webinar to a close. I want to thank David and Cam for all your great content today and fielding questions from our membership. We truly appreciate your time. To our participants today, you'll be receiving a follow-up survey via email this afternoon. We appreciate hearing from you and hope that you'll find a few moments to fill out the survey and let us know how we did today. We would also love to hear from you about topics that we can cover in future webinars, so please let us know. Our next webinar is actually next week at the same time, 2 o'clock. We hope you can join us for the next topic. Gwen Hardy of Electra Communications will be sharing insight on public relations and communication strategies during the pandemic. So that's it for today. Thanks, everyone, and we'll see you next time.
Thank you.
Thank you for having us.